today. It's been a lot of fun to be able to sit through all the sessions. And the one I just got to participate in, we got to create global problems and solve them. So that was a lot of fun. But Sarah asked that I spend some time and talk about the future of responsible investing from my perspective. And I'd like to tell you a little bit about what we're doing, how I see this, and perhaps add to some of the discussion that I heard around the room today. A lot of what we heard was focused around ESG, ESG data, metrics, decision making. And I think ESG is part of what we do, but it is nowhere close to the end. And in some cases, it's probably not even the means to what we're trying to do. So let me step back from that and give you my perspective on what it is that I think all of us in the room are involved in. We're trying to connect the global capital markets to the business of moving society forward. And we need to connect the global capital markets to this because it is, in fact, corporations and private enterprise that lie at the heart of every major problem that we have and every major solution that we have. So our business of responsible investing is really a business of attempting to create connections between the net benefits that corporations are supposed to supply to society and securities prices. We need to do that because the securities markets serve the rationing device of moving capital away from bad managements and towards good managements. And at the end of the day, the collective efforts of everybody in this room are really designed to ferret out that information. Who are the good managements out there? Who can make efficient and effective use of human, financial, and natural capital in order to solve the most important problems that our society faces? And who are the less good or the bad managements, and how can we create mechanisms to move money in the right direction? So today, we are all working with very imperfect but rapidly evolving information sets around corporate non-financial behaviors. That's what we're calling ESG. We have extremely good information about financial metrics. Today, we have 330,000 Bloomberg terminals deployed in the financial services industry with about 500,000 well-trained professionals looking at the same data, trying to figure out which company might make more money than the other. We have an entire educational system built to create advanced degrees on financial analytics. We have a regulatory framework that the SEC has put together to help on financial disclosures and required information. And we have a global audit system that's designed to give us information about the accuracy of the information these companies are providing. We are attempting to form up something like that around non-financial behaviors, around non-financial information. That's what SASB is all about. That's what we're all about. That's what we're trying to do. We're trying to get more information so we can do a better job of gauging the net benefits that corporations are providing or not providing to society. We're trying to create the plumbing so we can adjust securities prices accordingly, and we're trying to move money and solve these problems. When I think about ESG, ESG is just the current stopping point along this journey of creating more productive financial markets globally. When I think about responsible investing, I think about four major components. From an asset owner's perspective, from a large investor's perspective, the first component is getting the financial return right. There was some discussion today about whether or not ESG-oriented portfolios perform better or worse than the market. At some point, and I think we're probably there, that question will stop being asked because it's just part of investing. But it is still very important to recognize that in this business, we do have to get an attractive, sustainable financial return on large pools of capital. That's the system we live in. The second piece of responsible investing is understanding the full set of impacts that one's investments have. In other words, as a large investor, we need to understand whether our investments are contributing to climate change, whether they're contributing to social injustice, or whether they're solving those problems and creating a more sustainable and just society. It's our responsibility as a large investor to do the research, to develop the systems so we can answer those questions. It's not acceptable to just make investments for a financial return that may be contributing to global instability in a less sustainable system. The third major piece of being a responsible investor is being competent and able to engage with management. We need to be active as share owners. We need to be able to talk with managements, file shareholder resolutions, if necessary, file lawsuits, and ask managements to do a better job in terms of meeting their burden, their duties to all stakeholders. That requires intensive research. So understanding the full scope of your investments, all the impacts, and being competent and engaging with boards of directors and company managements to incentivize and create better behavior, more well-run companies, moving companies forward is an essential responsibility. It's how the capital markets work. It's built into our system, and investors who don't do a good job with their proxy voting or their corporate engagement aren't meeting their responsibilities as wealth-oriented entities. And I think the fourth and final piece of being a responsible investor is being able to invest in a way that has a positive social impact, either through the first set of activities that I described, or being able to make investments in high social impact, high environmental impact deals. That might be private equity or VC. It could be community finance notes, but a substantial fund needs to be able to make direct investments that can get money to parts of society that aren't being funded by the rest of the capital markets. That, I think, is an essential responsibility of a large asset owner. So in terms of the things that I heard discussed today, I think we can move well beyond the concepts around ESG investing, but we need to wrap it together and recognize that this is all being done in the context of a democratic global capitalist system. So we need to get those returns right and stop asking this question as to whether or not these disciplines outperform or not. I would also just like to make a couple of comments on work that we've done at Calvert and perhaps how that relates to work that many of you, academians and students and other professionals are doing. I think in the prior history of socially responsible investing, we all know that a lot of negative screens have been used. When we think of what is considered to be the state of the art in ESG investing, we're still using a lot of very imperfect information that is voluntary disclosures from companies. What I've done is to build a research system that looks at the global capital markets along narrow peer groups and allows our analysts to score, rate, and rank companies based on their corporate non-financial behaviors relative to appropriate peers and behaviors that we think are material to the risks that these companies are creating or dealing with relative to their societal actions and their environmental actions. Gives us a scoring system. Now, here's where we come up short consistently as an industry. We don't have very good information about the actual impacts that corporations are having. And I think that if the work that all of us are trying to do in this room is really going to move forward at an adequate pace, we need to have the same kind of information about corporate outcomes that are environmental and social as we have on financial. So it's not good enough to know what a company's policies are or their procedures are. It's not good enough to know that they've got a controversy score that's unattractive because of some corporate problem that they had. We have to really understand how well they're interacting with society and the environment, and we need the same kind of metrics there that we have on the financial side. Until we've got that, our work is going to continue to be short of what it can be. Certainly that's something that we're working hard to identify. NGOs, governments, academians around the world who can contribute to this solution. We're working with SASB, we're working with the United Nations, but I would encourage everybody in this room to spend some of your time working on that solution, because once we can create real standards, we can really adjust the cost of capital properly, and we can do a better job of getting money to the management teams in the companies that are solving these problems and move it away from those that are badly lagging or not paying attention to these risks. Thank you very much. Be happy to answer any questions if we have a couple of minutes left. Paul.
Sure. Thanks for your leadership over decades, not just years. And if you could talk a little, can you talk, I know you're leaving Calvert now, but some of the lessons that you've learned in Portfolio 21, where the take-up for the innovative approach that you had was somewhat hampered by some of the vested processes in the financial industry, like you pay for distribution, and if you don't, it's hard for customers to get access because their brokers and advisors sometimes prioritize commissions over the best product. So are we in a position now where that can shift, where customers can have more demand and hold their advisors and brokers?
Sure. Let me take that question and add to it, if I may, and just acknowledge that today we saw some information from the case studies that showed this tremendous growth and interest in impact investing, or tremendous growth in impact and responsible investing. And that's true. I experience it every day. You do also, whether it's from large institutions or retail investors. The concern that we should all have is that the way that that interest is met is inadequate or very imperfect. And so the well-intentioned asset owners end up coming up short in terms of the solutions that they're provided. So I think that the quality of the work is incredibly important for this particular effort, much more so than anything else that's gone on in the financial markets to date. Let's face it, we sort of blew it on housing, right? And there's a number of things that we can look to and show where there was great promise in the deployment of capital, but the financial industry got it terribly wrong. I don't think we can afford that to be the case here. And that's why I think we need to pay very close attention to the United Nations Sustainable Development Goals. And we should all understand the unique action that the UN took to wrap private enterprise into the development of the SDGs. There are 17 major goal sets. If you haven't paid attention to those, I would urge you to. And I think that one of the big opportunities we have as an industry is to map those SDGs into the financial markets and be able to measure companies on how they're doing there. I think, Paul, if we can do those kinds of things, we can get through any impediments that the distribution systems put up to us, because it's such a compelling story. If we get it wrong, well, I think we've blown just a tremendous need that society has. Yes.
So you touched on, again, thank you for coming in and speaking with us. You touched at the end on measuring and focusing more on the impacts that some of these corporations are having, and really getting into making sure that the policies are translating into actually on-the-ground impacts. And then you mentioned working with NGOs, intergovernmental organizations, academians, things like that. Do you think there's a role for private corporations in that, whether it's ESG assurance or kind of impact auditing or something like that?
I think for sure, yeah. The reason we're able to do what we're doing today is because of the information system that private companies have built. If we didn't have the information system that's been built globally, we wouldn't know what we need to know to understand where the problems are coming from, and we wouldn't be able to find the solutions. So private enterprise, private companies have a great role there. I think that the demand for this information and the number of participants who are coming into these markets is so large that the risk is that people will buy imperfect solutions very, very quickly. Somebody was here from UNPRI earlier, and they've done a great job. They've gone from zero. We were one of the founding signatories in 2005 of the UNPRI. To 1,400 financial institutions have signed up and said we're going to factor ESG into our investment decisions. $60 trillion in a short period of time. Most of those people are trying to figure out what they signed, right? And so the opportunity to sell them something, to get them in compliance that is imperfect is great. So yes, I think there's a role for private enterprise in this. The need is vast, but boy, let's make sure that we get it right. Yes.
I'm curious what you see as the most important driver, the most important sort of character in moving forward these kind of solutions. Would it be the demand side? Is it, we're seeing advisors or investment managers not having good products to give their clients who do demand it? So would it be those actors? Who do you think can make the most impact?
Well, shareholders. So what's the most important factor moving this mission forward? It's really the largest asset owners, and it gets down to corporate governance. So the things that are, the outcomes that we look at, companies' policies in terms of, how they use energy and natural resources and how they treat different pieces of society. It really comes down to their corporate governance structures. Otherwise, their activities are transient and they're related to the management that's in place at a given time. So to move governance forward, we need large asset owners to really come together, understand the issues. And so I don't want to say that it's the top 50 asset owners in the world because it's broader than that. But I think that today the 500 largest companies in the world account for more than 70% of the market capitalization around the world. So one of the things that has happened over the years is that we've had greater and greater concentration of power. And what that means is that a smaller and smaller number of very large organizations are controlling impacts on social and environmental outcomes for the globe. And in order to effectively change those behaviors, we need large asset owners to work together and really understand how they can impact those governance systems. Again, I don't want to say that the SDGs is going to solve a lot of stuff because the SDGs are just really an idea. We need people to come around to that. But again, what the UN did was they brought together governments, and they didn't bring together finance ministers. They brought together CEOs of governments. They brought together private enterprise, and they brought together all these NGOs. That's the group that we need to get together and to change these behaviors. And they need to change them at the largest companies in the world. I'll just tell you a quick story. I was a delegate there. We had a lunch on Sunday, and it was kind of a small group of about 75 people. and Angela Merkel. It was CEOs of companies and countries. So Angela Merkel was there, Obama was there, Zuckerberg from Facebook was there, of course Paul Pullman from Unilever was there. Our surprise lunch guest was Bono from U2. And he was pretty good. He said metrics 4 times, and he was able to reference Dodd-Frank. And we all know this is the 800th anniversary of the signing of the Magna Carta in 1215, an enormous document that really shaped modern civilization. And I couldn't help but think, if we have this group of people together, and Bono's saying metrics, and we have this effort, maybe we'll look back at some point and say 2015 was a transformative year and was an inflection point. But in terms of the big thing that we need to have happen, Sarah, we need everybody to focus on the largest companies, get their governance systems to address these issues properly, and adjust the price of money, adjust the cost of capital, so we can move it effectively between them. That's how our world works. That's the only way we're going to solve these problems. And we can solve them, but we need to do it that way, I think. Yes?
Thanks. Can I ask about, so climate risk isn't diversified, or rather it is actually, so it affects like every asset class. And so the question, I guess, just maybe in terms of negative screening is how do we really like embed so even if you're not doing an impact fund or intervention or project, just embed the process of ESG screening normally. And I just remember I was at a PR thing a few months ago, and I was talking to a Finnish guy and basically saying that this is how we do it here routinely, to look at climate change impacts, demographic changes for urbanization, and not even necessarily for a impact-minded sustainability project.
Sure. How do we make the analysis of a company by mainstream investors?
Just to give a comprehensive risk assessment, I guess.
Right. And so I think that it's beginning to happen. I think that's why we have so many smart people in the room today. And the change, I think, that people are beginning to talk about is the concept that the role of the corporation in society is changing. In other words, we now expect corporations to take responsibility for their social and environmental impacts. And that's happening. And we can see a lot of evidence that our society, young and old, rich and poor, everybody is now looking at companies with the expectation that that company is going to be responsible for the impact that it has on every aspect of society and on the environment. So that change in societal expectation for the role that the corporation plays is happening. And there's a lot of evidence to say that the securities markets are already figuring out how to build that into stock and bond valuations. You can look to mechanisms that have been in place for a considerable period of time, whether it's Tobin's Q or other measures of securities valuation. So I think it's happening. Not fast enough, not well enough, and that's why we need to build more information.
Yeah, I was just going to ask, a lot of people here in the room are kind of wondering where to go to get the greatest impact. And I was just wondering what advice you would have if you were to kind of go back and think about starting your career path as far as charting a trajectory towards having that greatest impact. Because you've talked about it has to be at large companies, definitely at investment advisories, definitely at the fund manager level. We need better data. Just what would you most be excited about in one hand? And on the other hand, what do you think would make maybe the greatest impact for a career?
All right. Well, I started my career at Lehman Brothers when it was private. So unfortunately, you can't follow that path. It was a great company in 1985. But I do think that getting into a position to impact very large companies is important. it's a lot of fun making high impact private equity and VC investments. I get to do that all the time, and it's very rewarding. But in terms of really having an impact globally and solving these enormous problems, and let's be clear, environmental problems are social problems. We're all going to be fine here in this room if the planet heats up, right? We're going to move. We're rich. We can deal with it. But there's about 3 billion people who can't. So these are social problems and environmental problems. And so I would just say, go into the global capital markets and think big, because that's where the solutions are going to come from. I think you mentioned to me, did you do some time with the Peace Corps? Yeah. So I think those are absolutely appropriate things to do for a while. And I think it also being able to you have some time spent with these small and medium-sized enterprises in places where people aren't uniformly rich is very useful. But I think to your question, where can we go and have impact? Government regulation matters. Government policy matters. So if you want to do something along those lines, get in there at the highest level you can. And next, working in the global financial markets, making decisions on allocating large amounts of money, researching big companies, I think you can have an impact there, a big impact. I think this piece about activism that I mentioned earlier, being able to engage with company managements, file shareholder resolutions, file lawsuits, get Amazon to hire sustainability officers, right? Get them to change their practices. Get Amazon to get rid of the diesel generators that are fueling their data centers and use more hydro, use more solar. Those types of activities across the board, they matter. They're helpful. Yes?
Good afternoon. I have a question about how to sort of foster a more interdisciplinary perspective on the integration of social, economic, and socio-technical systems that once there's large pension funds starting to invest in big systems, these sort of considerations need to be taken into account. The effects of these investments, what you referenced to, but in sort of in perspective of the sort of rigid economic focus of a lot of institutions and education, right. Specifically the education of a lot of wealth managers.
Right. So I think what you're perhaps talking about is what are the most important next steps so people can focus not only on getting an adequate financial return, but how can we get them to also focus on these important impacts? What are the steps there, and how can we make that happen? Well, it is happening. It is beginning to happen. And again, I think that data is extremely important. Metrics in data, so we can have accurate and uniform measurement of these impacts, so that can work its way into the capital markets. It doesn't sound that exciting, perhaps, but it is incredibly centric to the way our system works. And one of the things that our group, and it's thousands of people who care about this stuff worldwide, one of the things that we have not done is we have not built those standards and those systems so that when Dow Chemical says we're using less energy, we have a reliable way of proving that up, getting that information in a way where we can compare it to another company and determine who's improving at what pace. I would say, though, that there are a lot of big investors who are moving money, getting a decent return, but they're no longer asking for the top return. So George Soros, Bill and Melinda Gates, there are other big-time investors who are moving money into developing safe, clean power systems in Africa, in India, in ways that are going to make a difference to hundreds of millions of people. And they're going to get a decent return, but it's going to be an 18% return and not a 26% return because of the way that they're doing it. So there are people out there who are leaders, and they're not waiting for the metrics. But you asked specifically about big pension funds, and those people have a principal agent problem. It's not their money, so they don't necessarily have the same kind of incentives that some of the world's wealthiest people do. And in order to give those people the freedom to make the right decisions, we need to give them the numbers so they can show their constituents why they've done what they've done. So that's, we need the numbers.
One more quick question.
Great. Nobody wants to be last, Sarah. Yes.
So you have this vision for our entire kind of capital market structure, or at least how decisions are made, capital decisions are made to change. What do you think would be the one or two next major kind of signposts or things that you think need to happen or you want to see happen that will actually signal that we're moving in that direction?
Well, I honestly do feel that we're moving in that direction. So that day has come and gone. I think that it would be very important for our financial regulators to do a much better job of understanding these issues. So right now the SEC is somewhat unwilling to step up. I don't think they liked the conflict minerals portion of Dodd-Frank. In fact, they've told me that. They don't feel that they're, so we have a need as a society to have appropriate government regulation and policy to help the free enterprise do a better job of solving these problems. And nobody today in our society really wants more regulation, so it's not very popular to say we need more regulation. We can just say we need better regulation. So I think one big piece would be, and we can see Obama's administration in this last year, they're trying to knock stuff down, right? They got the DOL to move on the fiduciary stuff, bang. I don't think they're going to be that successful with the SEC in terms of getting them to take real action. I don't think they're that focused on it, but that would be one piece. The European regulators quite a bit better, and there was a question in one of the sessions about securities exchanges. So one place we can go that isn't a government regulator is to securities exchanges, and we can ask securities exchanges to have listing requirements that include required disclosures. So that would be, that would be a reasonable step. So these aren't the big bang exciting things, but we're on the move. We need our system and our structures to swing into gear and keep this momentum going and hasten the pace. You've been very generous with your time. Thank you very much.